Credo Technology Group, ticker symbol CRDO, one of the fastest growing and most talked about companies in the AI semiconductor space. This company has skyrocketed, and by the end of this video, you'll understand exactly why this stock has exploded, where it stands financially, and what risks and opportunities lie ahead. Nothing in this video is financial advice. I'm not a financial advisor. Please do your own research. Credo Technology Group was founded in 2008, and since then it has grown into a key player in the global semiconductor and connectivity sector. The company develops high-speed optical and electrical solutions used across data centers, cloud computing, hyperscale networks, and AI infrastructure. Their products include high-wire active electrical cables, low-power line card PHYs, seared chiplets, PAM, 4-signal processors, PCIe retimers, and a range of IP licensing services, all essential technologies for moving massive amounts of data quickly and efficiently. With operations across the United States, Taiwan, mainland China, Hong Kong, and beyond, Credo focuses on supporting hyperscalers, enterprise HPC customers, and networking manufacturers. Financially, the company brings in roughly $796 million in revenue and has a market cap of $34 billion, all while operating with a relatively small workforce of just 600 employees. Now let's talk valuation, because this is where things get intense. Credo scores 0 out of 6 on the valuation scale. Across every major measure, fair value, peer comparisons, and industry pricing, the stock appears expensive. According to discounted cash flow analysis, CREDO's fair value is about $76, but the current price is around $188, meaning the stock is trading at a 146% premium. Its price-to-sales ratio sits between 42 and 49, compared to the semiconductor industry average of just 5.3. Even giants like NVIDIA and Broadcom trade at far lower multiples. Compared to its estimated fair PS ratio of about 20.8 times, CRDO is clearly deep in the overvalued territory. But despite this extreme valuation, investors remain very optimistic, and here's why. Credo earns a perfect 6 out of 6 score for future growth expectations. Analysts are predicting some exciting growth: 30.4% in earnings, 23.9% in revenue, and 24.5% in EPS, with ROE hitting 34.4% in 3 years. These are outstanding numbers. To put them in perspective, the U.S. market grows earnings at around 16%, while Credo is forecast to grow at nearly double that. Revenue growth for the overall market is about 10.5%, vs. nearly 24% for Credo. Even compared to its own fast-moving semiconductor sector, the company still outperforms. The industry expects 26% earnings growth, but Credo pushes toward 30%. Analysts have also raised guidance recently, increasing revenue expectations by 18% and boosting one price target by 39%, further evidence of strong sentiment. This explosive growth outlook is the main reason investors pay such a premium for the stock. Looking backward, Credo has delivered some of the strongest earnings growth in the entire semiconductor industry. Over the past several years, earnings have grown 54.8% per year compared to the industry's 5.6%. Revenue has grown 43.9% per year. Recently, earnings growth hit 70.9%, and EPS growth reached 73.7%. Profit margins are strong, with 26.6% net margin. Return on equity currently sits at 16.5%, beating the industry average. The company only recently became profitable, but once it crossed that threshold, growth accelerated dramatically. Quarterly revenue continues climbing, though profitability can be uneven, typical for a rapidly expanding tech company. CRDO's balance sheet is one of its biggest strengths. The company has $0 in debt, a 0% debt-to-equity ratio, over $813 million in cash, total assets of $1.45 billion, and total liabilities of only $163 million. This gives Credo tremendous financial flexibility, no interest payments, no refinancing risks, and no pressure from lenders. For a high-growth semiconductor company, this is incredibly rare. Management quality is another major strength. Credo scores 4 out of 4 in this category. The CEO, Bill Brennan, has been leading the company for over 11 years. He earns about $6 million per year, with 90% of that tied to stock and performance directly aligning his incentives with shareholders. He personally owns 1.15% of the company, worth around $339 million, and the broader leadership team all have long tenures and meaningful ownership stakes. However, there is one red flag. Insider selling has been high. In the past 3 months alone, insiders sold over $12 million worth of shares. In the past 6 months, that number jumps to $49 million. And over the past year, over $55 million worth of shares were sold, with zero insider buys during that time. Ownership structure shows 76.5% institutional ownership, 12.6% general public, 10.9% insiders. High institutional ownership can stabilize the stock, but insider selling is something investors should monitor. Now let's quickly go over some key stats so you can see exactly where CRDO stands in the market right now. The company has a market cap of about $32.6 billion, with annual revenue coming in at $796 million. Earnings per share sit at 1.1456, and the stock trades at a very high price-to-earnings ratio of 164. CRDO is also a high volatility stock with a beta of 2.60, and over the past year it's delivered an incredible 171% return for shareholders. One thing to note, the company pays no dividends. This is a pure growth play. The stock typically trades between $186 and $192 during the day, and the 52-week range is extremely wide, from $29 all the way up to $213. All of this tells us one thing. Credo is still deep in its growth phase. High volatility, high valuation, and very high expectations. Their most recent financial summary shows modest revenue growth and excellent gross margins, but net income remains negative. This reinforces that Credo is choosing to reinvest heavily in the scaling rather than focusing on short-term profitability. So what's the bottom line? Credo is one of the most exciting companies in the AI connectivity space. It offers extremely strong revenue and earnings growth, incredible financial health with zero debt, a highly experienced leadership team, and a massive market opportunity ahead of it. But it also carries real risks. The stock is massively overvalued by traditional metrics, highly volatile, and has recently seen heavy insider selling. Profitability is improving long-term, but can still swing quarter to quarter. This is a high-reward, high-risk play, a company priced for a very bright future, and one that investors believe could play a foundational role in powering next-generation AI infrastructure. What do you think? Is Credo a long-term winner, or is the valuation simply too high? Let me know your thoughts in the comments.